If you still believe the biggest risk to your savings is a stock market dip, I want to offer you a harder truth. The more dangerous risk is often much quieter. It does not announce itself with a crash on television. It does not come with dramatic music and breaking news banners. It comes through the steady erosion of what your money can buy while officials tell you the system is being stabilized. That is the kind of danger I think many Americans are walking toward. Now, the United States is paying an extraordinary amount of interest just to keep its debt alive, not to reduce it, not to solve it, just to service it. That is an important distinction because once a borrower reaches the point where interest itself becomes a national problem, the mathematics of the situation begin to change. At that stage, the debate is no longer about what would be ideal. It becomes about which unpleasant path is still politically possible. That is the real issue. People keep talking about rate cuts as though they are some neutral policy adjustment. I do not see them that way. In a heavily indebted system, rate cuts are not simply about helping growth. They are part of a larger struggle over how the debt burden will be carried, who will absorb the pain, and whether the burden will be reduced honestly or disguised through the shrinking value of money. That is why I want to talk about this as plainly as I can. The Federal Reserve may soon be asked to deliver cheaper short-term funding. The White House obviously prefers lower borrowing costs. The Treasury obviously prefers lower borrowing costs. Markets have grown addicted to lower borrowing costs. The trouble is that lower short-term rates do not automatically solve the bigger problem. They can just as easily reignite inflation expectations. And when inflation expectations rise, long-term lenders demand higher yields. That is where the trap begins. You cut the front end to relieve pressure. The long end pushes back because bond buyers know inflation is eating the value of the coupons they are being offered. So the government gets temporary relief on one side and more pressure on the other. That is not a solution. That is a transfer of stress from one part of the curve to another. If the United States were a household, the picture would be easier for people to grasp. Imagine a family drowning in debt. Their monthly interest expense is rising, old low-rate loans are maturing. New borrowing costs more. They cannot realistically slash spending enough to solve the problem. They cannot refuse to pay without blowing up their credit and their future. They hope income growth saves them, but hope is not a repayment plan. What options remain? That is exactly where the country is. There are only a few exits from an oversized debt burden. People like to pretend there are many because many options sound more civilized. But when you reduce the problem to arithmetic, the menu gets very small. The first option is to run real surpluses and pay the debt down. That sounds responsible, and in theory it is, but theory does not vote. The political system has almost no appetite for the scale of spending discipline and taxation that would be required. When a country is already accustomed to borrowing heavily, serious austerity becomes not just unpopular, but destabilizing. The public wants benefits, defense entitlements, subsidies, and growth all at once. Very few voters line up to volunteer for a decade of restraint. So while I respect the moral appeal of paying your way honestly, I do not think that is the path policymakers are choosing. The second option is outright default. That is even less realistic. The United States sits at the center of the global financial system. Treasuries are the foundation under countless balance sheets, collateral arrangements, reserves, and asset. Pricing models, a true default would not be a cleansing event. It would be a systemic detonation. It would destroy trust far beyond Washington. So when people casually say perhaps the government should just refuse to pay, they are talking nonsense. A borrower at the center of the system does not default cleanly. It drags the system through broken glass. The third option is to grow faster than the debt grows. That is the most optimistic answer and therefore the most popular one in conversation. Maybe technology saves the day. Maybe artificial intelligence unlocks a productivity miracle. Maybe automation boosts output enough that the entire debt burden shrinks naturally relative to the economy. Possible. I never dismiss productivity. Productivity is the only durable source of rising living standards over long stretches. But you do not solve a present debt problem by worshiping a future miracle. If technology helps, But if it helps enormously, even better. But hope is not a strategy, and governments that are already under financing pressure cannot afford to behave as though optimism alone is policy. That leaves the fourth option: inflate the debt away. This is the option nobody describes honestly because the plain description sounds ugly. But it is often the path governments choose when the debt is too large to reduce cleanly and too important to default on. Inflating the debt away does not mean the debt vanishes. It means the measuring stick changes. The debt remains in dollars. But if those dollars buy less over time while nominal incomes and nominal GDP rise, then the debt burden feels smaller relative to the economy. The public sees the same number of dollars. The government sees a lighter real burden. The saver sees his purchasing power quietly drained. That is the trade. It is one of the oldest tricks in finance because it allows officials to reduce the weight of debt without passing a dramatic law that openly confiscates wealth. They do not have to announce a levy on savers. They merely preside over a system in which currency weakens while liabilities stay fixed in nominal terms. To see why that works, imagine a man who bought a house with a large mortgage. On the day he signed the loan, the mortgage was a heavy percentage of the home's value. Then inflation pushes prices higher across the economy. His wage rises somewhat. The house rises in dollar value. The mortgage balance does not disappear, but it becomes less suffocating relative to everything measured in inflated dollars. He is paying the debt back with cheaper money. That is exactly what a government does when it relies on inflation to ease a debt burden. The debt is still there. The pain is moved elsewhere, moved to cash holders, moved to bondholders, moved to wage earners whose raises do not fully keep pace, moved to retirees who discover that a stable account statement is not the same as a stable life. People need to understand that financial repression is not some obscure academic phrase. It is the quiet discipline of savers for the benefit of debtors, especially governments. And if you study history honestly, you find that when debt gets big enough, governments often prefer quiet discipline to open confession. The post-war period offers a useful precedent. After World War II, the United States had an enormous debt burden relative to the economy. Policymakers faced a familiar problem. How do you finance massive obligations without letting borrowing costs spiral and crush the system? Back then, the Treasury and the Federal Reserve worked in a much more openly coordinated fashion. Short-term rates were kept very low. Long-term yields were capped. If inflation pressures tried to push long-term rates higher, the Federal Reserve would buy bonds and suppress the move. That kind of arrangement is called yield curve control. The important point is not the label. The important point is the purpose. Keep government borrowing costs low enough that the debt remains manageable. That arrangement helped reduce the post-war debt burden relative to GDP, especially when combined with strong nominal growth and productivity gains. But it did not come without cost. Inflation surged. People who held fixed claims in a world of rising prices did not exactly enjoy the bargain. The public paid in reduced purchasing power even while the government improved its position. That is the pattern worth remembering. Governments call it stabilization, debtors call it relief. Savers experience it as erosion. Now here is where the history becomes especially interesting. Most people hear the words Treasury, Fed Accord of 1951, and assume it was some noble agreement where the central bank and Treasury agreed to work more closely together. That is not the important lesson. The deeper lesson is that the Federal Reserve was trying to escape the degree of Treasury dominance that had developed. The central bank wanted freedom to set policy without being forced into bond support that served government financing above all else. In other words, the famous accord was not chiefly about surrendering independence. It was about reclaiming some. That is why modern talk of a new kind of accord should make thoughtful people nervous. If the direction of travel is back toward coordination designed around the government's debt needs, then you are not watching a normal adjustment. You are watching the system rearrange itself around a financing problem. And once that is the real objective, the question becomes very simple. How do you cut short-term rates without letting long-term rates explode? Because if long-term yields break upward aggressively, then the debt spiral gets worse. The government's financing burden rises. Private borrowing gets more expensive. Housing suffers, valuation math suffers, banks feel it, the whole structure tightens when it needs relief. That is the contradiction. You want to make money cheaper. But if the market believes that cheaper money means more inflation, it can punish you at the long end. In the last great round of intervention, the Federal Reserve solved that problem in a direct way. It bought longer-dated bonds, it absorbed supply, it kept long-term borrowing costs contained. That was explicit balance sheet support. A central bank that dislikes that method, or a new chair who has criticized it, still faces the same underlying math. The problem did not disappear just because the rhetoric changed. So if a future Fed wants lower effective borrowing costs without openly returning to the old style of bond buying theater, it needs another mechanism. That is where the plot gets interesting. Many investors assume policy only works through the obvious channels: cut the rate, raise the rate, buy bonds, sell bonds. But the system is far more subtle than that. The identity of the buyer matters just as much as the existence of the buyer. If the central bank does not want to be seen directly absorbing long-term supply, someone else has to do enough absorbing to keep the market from demanding much higher yields. The question then becomes who. One possible mechanism sits inside the Fed's own portfolio structure. If the central bank shifts what it holds, replacing some longer duration exposure with shorter treasury bills, it can indirectly support the government's financing needs without making the optics look identical to prior rounds of money printing. That is technical. But the bigger point is this: portfolio structure can be used as policy. Balance sheet composition can matter even if the headline size does not change dramatically. Still, I do not think that is the whole answer. The more important mechanism may run through the banking system. This is the part people should watch closely because it changes who effectively absorbs the debt. Banks are large buyers of government paper, but they are also regulated institutions. That means their appetite for treasuries is shaped not only by yield and demand, but also by rules governing leverage and capital treatment. One of those rules is the supplementary leverage ratio. You do not need to memorize the acronym to understand the significance. What matters is that this kind of rule limits how much balance sheet expansion banks can comfortably pursue relative to their capital base. If certain constraints are relaxed, the banking system can take on more government debt. That changes the demand picture in a major way. A few years ago, when those constraints were temporarily loosened, banks had more capacity to absorb treasuries that mattered. It helped create demand where demand was urgently desired. If a similar relaxation became more lasting, then the banking system could once again be encouraged to do a job the central bank may not wish to do openly. In plain English, banks could become a much larger buyer of government debt. Now ask yourself the obvious question: what do banks sit on? Deposits. The public's money. The banking system is not some abstract machine floating above society. It intermediates the savings of households and businesses. So if policy steers banks toward becoming a larger absorber of government debt, the effect is not magically costless. It means private capital and private liquidity are being channeled into supporting public finance that can hold down long-term yields more effectively than the market would have chosen on its own. It can also help the government borrow at rates below the pace of inflation, and that is exactly how financial repression works. The debt is made lighter in real terms. The saver is paid less than the inflation he experiences. The gap is the tax, not a voted tax, not a visible tax, a hidden tax. That hidden tax is so politically attractive because it does not require a direct confrontation with the public. There is no need to mail every household a letter that says, "We have decided to make your cash and fixed income assets less valuable in order to solve a debt problem we could not solve, honestly." Instead, officials speak in the language of stability, liquidity, market functioning, prudent coordination, and lower volatility. Those phrases sound technical. The lived experience is simpler. Rent rises, food rises, insurance rises, repairs rise, a retiree holding bonds, and cash watches his standard of living soften. A worker gets a raise that feels encouraging for a month and inadequate by winter. A family with real assets and pricing power survives much better than the family holding only paper promises. That is why I think investors are asking the wrong question. They keep asking whether a policy like this would work. I think it probably can work, at least on paper, for the government. The more important question is for whom it works and who pays. Governments measure success one way. Families measure success another. A government can call it victory if the debt to GDP ratio falls. A family may feel no victory at all if groceries, energy, insurance, tuition, taxes, and healthcare keep outrunning the income from its savings. Do not confuse government relief with household relief. They are often sold together and delivered separately. So how should an intelligent investor think about this? Not with panic, not with conspiracy fantasies, with structure. I have said many times that investing is not a game of clever predictions. It is a game of sensible positioning. If the system is drifting toward a form of coordinated debt management, where short rates are eased, long rates are indirectly contained, and inflation does part of the deleveraging, then the obvious losers are holders of idle cash and long fixed claims that cannot keep up. That does not mean cash has no role. Cash always has a role. It gives flexibility, it gives optionality, it helps you think clearly. But large pools of idle purchasing power with no protection become dangerous in a period like this. Likewise, long duration bonds can look respectable while quietly becoming a trap if inflation remains firmer than expected, and yields are managed more for public finance than for savers' real returns. The people who tend to survive these periods better are the ones who own things that can reprice, things with scarcity, things with utility, or businesses with the ability to pass through cost increases. Land can help, certain commodities can help, businesses with pricing power can help. Selected equities representing real economic value rather than mere hope can help. Some exposure to precious metals can help, especially as monetary insurance rather than as an object of worship. The principle is not mystical. Own things that do not rely entirely on the kindness of the currency. That is the core lesson. If the measuring stick is being weakened, you want at least part of your wealth outside blind dependence on that measuring stick. Years ago, I knew a man who believed he was being conservative because most of his savings sat in cash certificates and fixed income products. He was careful. He disliked drama. He did not trust the stock market and thought he was avoiding risk. Then the world changed around him. His income from savings lagged badly, prices climbed, his expenses climbed faster than his income from assets. He still looked prudent on paper. His statements arrived exactly as promised, but his life became narrower. He drove the same car longer than he planned, which would have been fine by itself. He traveled less. He postponed home maintenance. He worried more. He cut small pleasures first and then larger ones. He did not experience a crash. He experienced erosion. That is the form of loss respectable people often fail to recognize until it has already reshaped their lives. I do not tell you that to insult caution. I admire caution. What I object to is false caution. False caution is when a person hides in nominal safety while real danger is doing the work. True caution asks a better question. What preserves not just the number, but the purchasing power, the options, and the dignity attached to that number? That is the question savers should be asking. Now, if I were arranging a family's assets in anticipation of this sort of environment, I would begin by separating money into jobs. One job is liquidity. You still need reserves. You still need flexibility. You still need short-term safety for expenses, emergencies, and the ability to take advantage of opportunity that argues for cash and very short-term government paper, but in moderated proportion and with your eyes open about what those holdings are for. They are there for optionality, not for long-term prosperity. Another job is inflation defense. That points toward real assets, scarce assets, and businesses with the ability to defend margins. A third job is monetary insurance. That may include precious metals for some families. Not because metals are magical compounding machines, they are not, but because when confidence in paper promises weakens, monetary insurance becomes more valuable psychologically and financially. A fourth job is productive ownership. You still want ownership of good businesses. I always will, but not every stock qualifies as a good business at a sensible price. Late in a debt, heavy cycle price matters a great deal. Balance sheet strength matters a great deal. The ability to reprice without destroying demand matters a great deal. The days when people could buy almost anything and rely on a falling rate world to rescue. Bad decisions were unusually forgiving. I do not think we should assume that same forgiveness. Another point deserves saying clearly. The government has one objective in a debt problem: make the debt more manageable. The investor has another: protect his household. Those objectives overlap sometimes, but not always. A policy that is successful for the sovereign borrower can still be punishing for the private saver. That is exactly why adults must stop consuming policy headlines like children reading sports scores. A rate cut is not automatically bullish for you. A coordination framework is not automatically stabilizing for your purchasing power. A lower nominal yield is not automatically good if the inflation rate running through your life is higher. Ask who benefits, ask who pays, ask how the burden is being shifted, that is grown up investing. There is also a political feature to all of this that investors ignore at their own risk. Open pain is unpopular. Hidden pain is easier to manage. A government that announces explicit sacrifice invites revolt. A government that engineers gradual erosion invites confusion. Confusion is politically easier to survive. People argue over the cause. They argue over the statistics. They debate whether inflation is temporary, sticky, imported, transitory, or exaggerated. Meanwhile, the effect keeps working. Debt becomes easier to manage in real terms. Savers become poorer in real terms. That is why I say the biggest risk can be the quiet one. Quiet risks last longer because they do not feel like a single event. They feel like life getting more expensive while the official language remains polite. By the time the public becomes angry enough to notice clearly, much of the transfer has already happened. So if I were sitting at a kitchen table with an ordinary saver tonight, I would not tell him to panic. I would tell him to become deliberate. I would tell him to stop assuming that nominal safety is true safety. I would tell him to examine every fixed income position and every large cash balance through the lens of real purchasing power rather than tradition. I would tell him to ask which businesses he owns that can survive inflation, defend margins, and remain necessary. I would tell him to decide how much liquidity he genuinely needs and how much idle cash is just inertia. I would tell him to think carefully about real assets and monetary insurance, not as fashions but as roles inside a structure. Most of all, I would tell him to stop waiting for perfect clarity. Perfect clarity usually arrives after prices have already adjusted. The intelligent work is done before the crowd feels comfortable calling the policy what it is. One more thing, people often think the danger in periods like this is that everything collapses at once. Sometimes it does not. Sometimes the system avoids collapse precisely by choosing slow confiscation instead. That can be even more deceptive because households keep waiting for the dramatic event that never quite arrives. They think that because the catastrophe did not happen, the policy must have been benign. Meanwhile, their standard of living is doing the suffering quietly. That is why paper success and lived success can diverge so badly. The debt ratio can improve. The household can still feel poor. The treasury can be relieved. The retiree can still be trapped. The central bank can call the transition orderly. The saver can still have lost ground every year. It was happening, so do not let the absence of a crash persuade you that the outcome is friendly. Sometimes the absence of a crash is the mechanism by which the transfer succeeds. And if that is the environment ahead, then sitting still is not prudence. It is participation without consent. Here is the blunt ending. The United States has a debt problem large enough that honest solutions are politically weak. Catastrophic solutions are unrealistic. And inflation-based relief is deeply tempting. That means the burden is likely to be reduced not by heroism but by dilution. The public will pay not through a dramatic headline tax but through the soft wearing away of each dollar's usefulness. That is what investors need to understand. The right question is not whether officials can make the numbers look better. They probably can. The right question is what you are holding while they do it. If your wealth lives entirely inside fixed claims and idle dollars, you are volunteering to absorb more of the adjustment than you realize. If your wealth includes productive businesses, real assets, pricing power, and some sensible monetary insurance, you stand a better chance of coming through with your purchasing power intact. That is not a guarantee. Nothing in markets is. It is simply a more intelligent alignment with the likely path of the burden. And in investing, alignment matters a great deal. You do not need to predict every speech, every meeting, or every quarter-point move. You need to see the arithmetic, respect the incentives, and refuse to be the last person at the table, still pretending that paper stability automatically means real safety. That is the job. Now, not excitement, not theater, preparation.